Saudi stocks just dropped 1.89%. What does that move signal, and how should investors respond today? The Tadawul All Share Index is flashing caution. A broad decline like this points to pressure from inflation and the outlook for higher interest rates. When borrowing costs rise, valuations compress and risk appetite cools. That shift is not unique to Saudi Arabia. Global markets are wrestling with the same forces, and capital is moving more selectively. Two macro levers are setting the tone. Inflation remains sticky, and central banks, including the Federal Reserve, are keeping rates higher for longer to contain it. That tightens financial conditions. It raises discount rates on future cash flows and forces traders to rethink earnings expectations and growth assumptions. In that environment, sentiment can turn quickly, and broad benchmarks feel the impact. Sector dynamics matter as well. Energy and materials have an outsized influence on the Tadawul. Oil price swings ripple through earnings, capital spending, and dividend outlooks. When crude is volatile due to shifting supply, demand, or inventory data, it feeds straight into sector performance and, by extension, the index. Materials follow a similar pattern as global manufacturing and construction indicators ebb and flow. There is also a rotation story. Digital assets have captured attention again, and some investors are rebalancing toward crypto or cash-like yields. Even modest reallocations can pressure traditional equities when liquidity is cautious and headlines amplify uncertainty. Why does this matter for you? Because it shows how interconnected the market is. Local shares respond to global policy, commodities, and cross-asset rotations. It also shows how quickly conditions can change when rate expectations move or oil reprices. Here is a practical playbook. Reassess your risk exposure to rate-sensitive and commodity-linked names. Diversify across sectors and geographies so one theme does not dominate your outcomes. Consider using broad and sector-focused ETFs to spread risk while staying invested. Emphasize quality. Strong balance sheets, steady cash flows, and disciplined capital allocation tend to hold up better when money is expensive. If you are adding positions, stage entries over time to reduce timing risk. And keep your plan anchored to your horizon. Volatility is a feature of markets, not a signal to abandon strategy. Stay informed, stay diversified, and stay disciplined. Read the full article at finlitica.com.